Certainly the trade discussions that have been going on, specifically or more pointedly between China and the U.S., have definitely been weighing on, most primarily I think, the emerging markets. I think it's had a big effect on the dollar, and it's caused a cascading effect there. And you have secondary effects into companies that are exposed to these regions, and that's been a big effect as well. I think another thing that we need to be aware of as well is just what's happening with U.S. Fed policy right now and the tightening of liquidity. So you've had a strengthening of the dollar this year along with a rise in interest rates. So that is definitely causing an effect that's having a negative effect on the emerging markets right now. It's also having an effect on the markets in general, as we're seeing the price of money as it increases. The discount rate at which we're looking at companies and markets is obviously going to affect the price of assets, and this is another effect that we're keeping a close eye on. What we've seen this year, especially for the last quarter, our energy and healthcare names have been very helpful for us. So in healthcare, we have Teva Pharmaceutical has been a big contributor over the last quarter. This is a company that has been through some difficult times over the last few years, and they have a new management team coming in. They're righting the cost structure. In energy, we've seen obviously oil and gas prices have risen. That's benefiting our energy holdings. We've been slightly overweight in energy, and that's been helpful. The areas that have been dragged on performance have been generally the financials, which is one of our larger positions within the portfolio, and unfortunately this last quarter we saw a big hit to the financials, especially in Europe. Our technology sector weighting has been hurting us, and it's really not necessarily the weighting per se as the holdings. We don't, as a value manager right now, we really don't own a lot of the high-flying tech stocks, companies that in our view they're highly valued and they're very strong momentum, and that's just not a part of the portfolio right now that's performing strongly for us. In terms of risks, things that we're keeping our eye on, certainly what's happening with respect to the trade discussions that are occurring. We really believe that there will be, this is just an example of an administration here in the U.S. that likes to start from a very extreme position and negotiate towards a middle. We think one of the other risks could be the rise in interest rates here in the U.S. And what will that effect be as we continue to drain liquidity? Some of the opportunities that we see are actually occurring, especially in the emerging markets, as we discussed. The emerging markets today are in much better shape than we saw back in the latter parts of the 90s when you had the Asian currency crisis, for example. And the businesses are in better shape, the countries are in better shape. So we're looking at this recent collapse in the emerging markets and their currencies as being offering up some pretty good value opportunities moving forward.